All right, ladies and gents, just here to drop a few cents. You're Earl, the money coach. It's Life Insurance Awareness Month, so I want to break down the history of life insurance so people can understand. I'm not here to talk about what's good, what's bad, just so you know exactly what kind of life insurances are out there. So make sure you like, follow, subscribe to the channel, and I'm going to give you guys some great content. But let's get straight to it. Let's go through the history, starting with whole life. Whole life insurance was the first life insurance that really was created out there. It's designed to do exactly what you hear for your whole entire lifetime. You're getting that when you're 30, you can go all the way up to age 121. You're good to go. So you do have that whole life. Now, they do have cash value, so you can use it as a saving strategy. Life insurance is not a investment. You hear insurance agents talk about it? No. Life insurance is not an investment. Some of them are a reflection of the market. So when the market goes up, you get a certain percentage. With a whole life, you're locked in. Hey, you're getting 3%, 4%, 5%, 7%, whatever the company's doing, you're locked in. The market goes up, the market goes down, your whole life is good to go. Understand that. Now, most of the time, people don't explain the loan provision. Since these are cash value, right? So there's five kind of life insurances out there. Four of them have cash value. For those that give cash value, there is a loan provision, which is the amount that you have to pay to be able to touch that money. Generally speaking, for whole life, anywhere from 3% to 7%. There is higher, but that is the average for a lot of folks. So you have $10,000 of cash value that you want to withdraw. There's going to be a loan provision, say at 5%, 6%, 7%, that you're going to have to touch when you have whole life. Now, whole life is known to be the most expensive life insurance out there. That's when it came out first. So then they came out, the people said, look, man, I'm not trying to spend all this money. That's too much. That's ridiculous. That's where term life insurance came about. No, hey, we're going to give you an insurance. It's going to be very affordable, but it's going to be limited to a certain amount of time. Generally speaking, you got 10-year, 20-year, 30-year term policies. You have a lot more. Some companies do up to age 65. So if you're 18, you go to age 65, that's a 47-year term. So there are companies that have a lot of things out there like that. But understand with a term insurance policy, you have no cash value. That's why it's very affordable. There's no cash value in there, so that means you can't take any money out. You're just getting the coverage of your term insurance. I got for 30 years. If something happens to me within 30 years, I'm paid out. Now, that is actually the old term life insurance because insurance has evolved, folks. So now there's living benefits. All these insurances have living benefits, and most companies should have it included. If you're not getting living benefits automatically included and they want to add on more as a writer, you need to look into something else. But what are living benefits? That's critical, chronic, terminal illness. Those are the big three. There's more you could add on. You could add on for children. You could add on accidental, all kind of stuff. But the main living benefits is critical, chronic, terminal illness. Critical illness, you have something you're about to die pretty much. Heart attack, cancer, strokes, cardiac arrest, all those kind of things where you possibly can die. That's the critical illness rider. And you could get, depending on the severity, depending on the company, some companies go from 25% up to 75% of your living benefit, sorry, of the face amount you could use. So you got let's keep it simple. You got $1 million of a life insurance. You have, let's say, stage one cancer. They give you 25%. They'll cut you a check for 250,000. Now, how do you get a higher percentage? Like stage one, you make it 25%. Stage three cancer, you get 55, 65%, depending on the severity. So you have that living benefits included, but understand it's still just within that term. Now, here's what you got to understand, folks. 98% of term life insurances do not pay out. Let me repeat, 98% of term life insurance does not pay out for two main reasons. Number one, because a lot of them lapse policies. You're paying 13, 14 bucks a month. People forget about it. You got 20, 25 bucks a month. Some people just forget about it. Those policies, that's number one. Number two, some people maybe lost a job. They can't afford it anymore. You have a grace period, but after that grace period, then your policy lapse. That's number one. That's the first reason why most people don't actually get paid out from term insurances. The second reason is you outlive your policy, which is what you're supposed to do. I got my first term life insurance when I was 25 years old. A 30-year term means by age 55, I've gone through 30 years. So guess what? Most people outlive their term policies. Some people they want to do that. You may have heard of buy a term, invest a difference. Some people love that strategy. Some people hate that strategy. I'm not getting into that right now. But most people may outlive their policies. So now what happens? Imagine I got mine when I was 25 in good health. You know, came out the military, working out all the time, great health. But now I'm 55. Guess what? 30 years down the road, when I'm 55, guess what? I got heart problems. I got a bad back. My knees hurting. Been to the doctors all the time. Guess what? My that $25 a month term policy for half a million is now going to cost me $190 a month. You see what I'm saying? Because now that you're older, it costs more. So that's what happened with term policies. Whole life is super expensive, but people said, I need something that's affordable. So they got term insurance, but then guess what? They started outliving the term and said, hold on now. I need something. I need a compromise. I need something in the middle. I don't want it expensive his whole life, but I need it to maybe last my whole life instead of just a term for a term. That's where universal, you hear UL's, universal life came in. Think of it as the middle ground. All right, is term insurance is the most affordable. Then you have your universal life. Then you have your whole life. So it costs a little bit more, but than your whole life. But here's the thing with universal life. Remember, it's still a permanent life insurance, which means what? There's cash value. But since it doesn't cost as much, guess what? The growth accumulation is not going to be as much. Where you have a whole life where you're getting guaranteed 4% or 5%, 7%, whatever the company's doing, universal life is generally regularly around 2 to 3%, right? So what does that mean? Rule of 72, take the number 72 divided by your interest rate. That's how long it takes money to double. So if you have a universal life at 2%, 72 divided by 2 is what? 36, meaning it's going to take 36 years to see your money double. That takes too dang long, but it's more affordable. It doesn't cost as much as whole life, but it doesn't grow as much as whole life, and then to take the money out, the loan provision is not as much. A lot of them are 2% to 4% instead of you paying, 4% to 8%. So you're not making as much, so it doesn't cost you as much. But guess what? You know us, folks. We don't like that. So you're telling me I'm stuck. I can only get 1 to 2%? Heck no. Show me the money. That's when the VUL, the variable universal life policy, came out, which is the only out of the five life insurances, is the only one officially in the market. Like I said earlier, cash value life insurances, whole life, universal life, index universal life, they're a reflection of the market, not in the market. They're not officially a investment. Life insurance is not investments until you get to IULs. You have to have a certain license. You need to have a securities license. So typically speaking, the life insurance agent you sat down with, 95% of them cannot do variable universal life because you need to have a securities license. But there's pros and there's cons. It's actually in the market right now. 2025 is a good year. You're up 17, 18%. 2022, what happened in 2022? You lost 30% in March. Guess what? What if you were trying to retire in March 2022? You just saw your portfolio, well, your variable universal life take a huge loss, right? So people are always changing. Whole life costs too much. Then term was too short, even though it was expensive. So then they want a universal life. Then they got variable universal life, which is part of the market. And that's when they said, hold on, let's see if we can make something that's truly good for everything. That's where the IUL Index Universal Life comes about. It's kind of a blend of all the other four life insurances. It's a blend of whole life, term life, universal life, variable universal life inside the Index Universal Life. So it's an index account, meaning it gets to participate in what the market could do. But they have a floor and a cap in your IULs, your Index Universal Life strategy. So let's say your cap is 11%. I'm just throwing out an example. Your floor is always regularly zero. Zero is your hero. Some companies I've seen that even on my platform, I've been licensed for the last decade. They have some companies that give you a half a percent, a 0.75% is the floor. The market crashes 30%, you can still get 0.75%. So you or 0.5%. But 95% of IULs, zero's your hero. The market drops 30% like it does in a bad year, 2008 when it dropped 40%, you were locked in. You didn't lose anything. So you have a floor, you have a cap, Like I said, let's say your cap is 11%. If the market goes 20%, you hit that cap. That's it. You're capped out. So it kind of gives you a little bit of that variable universal life where you can kind of get a little bit more gains instead of being locked in like a whole life or a very minute amount in a universal life. The loan provisions, like I said, whole life is generally the most expensive, 4 to 7%. Well, most of the universal life, variable universal, index universal, they're very small, regularly between 2.5%, depending on your company. Some companies actually, though, they give you what we call a wash loan. So for the first 10 years, they'll be like, hey, Mr. and Mrs. Client, it's going to be 2.25% loan provision for the first 10 years. But after that 10 years, if you want to take that money out, we'll give you a 2% wash loan. So it's only 0.25% to touch your money if you go that long for at least 10 years. You see what I'm saying? So it gives you a little bit of all the pros and the cons. But here's a con for all of them, which most people don't like talking about, is what is called COI, the cost of insurance. Folks, every product out there, there's some kind of, it's called different. You either call it like a tax, you're going to call it a fee, you're going to call something a penalty. Well, in this case, it's a cost of insurance. You're paying a little bit for some kind of service. Nobody does nothing for free, folks. We know that. So in insurances, you have a cost of insurance, which is regularly a very small amount. It could be regularly charge up per $1,000. So let's say so 1%. Oh, I'm sorry, not 1 cent for every $1,000. Just using an example. So you got $400,000 of coverage. They'll figure what that is, and then you go from there. But understand, cost of insurance. That's just one factor. There's a lot of factors, but cost of insurances do increase over time. If you're using like a universal life, if you're using your variable or index, these cost of insurances, you need to switch how the policy is structured. Now, what does that mean? Is when you talk to your insurance agent, they're going to say, we're going to have an increase. You're going to have an increasing death benefit. Why? So your money could increase. You could put more money in, let it work for you. But once you get of age, when you retire, you need to switch it from an increasing policy to a level policy. That way, your cost of insurances and everything is locked in. So you have to factor that in on how those are. Now, I have other videos talking about how to fund it and how it works, but you need to understand their pros and cons for all the insurances. Whole life, you get either or. Prime example. When I say either or, it's either your death benefit or cash, your cash value, whatever is more for most companies. So simple numbers. Let's say you have $100,000 of face amount for your whole life. So you pass away, you get 100,000. The cash that's accumulated over the years is 25,000. Guess what? It's either or. Your beneficiary gets 100 grand. Boom, the company keeps that 25,000 cash value. That's how whole life regularly started. For your term insurances, they're not really charging you anything, but they know 98% of people outlive their policy. It's just like your car insurance. You know, you're not getting in accidents, but you're paying for it all the time. Some of you haven't been to the doctor in 4 or 5 years, but you have health insurance. Same thing. That's how they make their money. When you have like a universal life, your index universal lives, all these things, to get some of these participation rates, you're going to have riders, and some of them come with a fee. And when I say a fee, it'll be let's say a 1% fee. So you may have what they call a participation rate. So some companies will tell you, hey, Mr. and Mrs. Client, we have a 160% participation rate, meaning whatever the market does, they're going to credit you 160%. So if the stock market does 10%, you get 16% in your account. But to get that, they're going to have a rider, which is going to have a rider charge, which could be, say, 1%. So, hey, the market does 10, 160% participation rate means you're going to get 16 minus that 1% for that rider to be able to use that. We'll credit your account 15. So every way you look at it, whole life, term, index universal life, variable universal life, regular universal life, there's going to be some way the company's going to get theirs in the back end. You just got to see how you want to have it work for you. But ultimately, in closing, understand life insurance is a tool to be able to add to your portfolio. It's not your only thing in your portfolio. It's something to add to your portfolio. It's the easiest way to leave tax-free money to your beneficiaries without having to worry about any of the issues out there. So it's a great part of your portfolio that you should have, that it'll be able to give you at least a floor so you're not losing your money. Zero is your hero if you're using cash value. I'm not saying what's better, term insurance, permanent insurances. Personally, I have both. Because I believe when I sit down with folks, I tell them this: look, term insurance, it gets you to retirement, permanent insurance gets you through retirement. All right, so use term to get you to retirement, permanent to get you through retirement. Great strategies to have. Understand there's pros, understand there's cons. This isn't a get rich quick, it's a get rich slow. If you want cash value from life insurance, be prepared to have it for 20, 25 years. Okay, so you have to understand that, folks. So I hope this was a great breakdown. Want you guys to like, follow, and subscribe to get more information on insurances, rolling money over, your debt, and leaving $1 million babies. And with that being said, I'll see you on the next one.